Good morning, everyone. I'd like to call our meeting of the CalHFA Board of Directors for February 21st in order and welcome everyone. Thank you all. We'll be working through some interesting projects later on in our session and getting an update on our the recent quarter. But before I go anywhere else, I would love to introduce to you our newest board member and Governor Newsom's recent appointee to be the head of the Consumer Services and Housing Division of the state, Tamika Moss. Thank you. Welcome. And you've read her bio, I'm sure, but I wanted to pass on one point where we've crossed trails. We talked about this earlier. In your early time in California, you were with the Tenderloin Neighborhood Development Corporation, and I was there as well on the board. Great to have you. Your heart is solidly with the people of California, and in providing affordable housing, you're going to be a great addition to the state. Love to have you on this board. So if you'd like to say a few words, we're all ears here.
Well, good morning, everyone. Thank you so much. I'll be very brief so we can get on with the business, but I'm really excited to be a part of this body, to support our director, Johnson Hall, and really I have spent the last 20 plus years working on behalf of our most marginalized community members. And so I'm really excited for the state service and continuing to do that good work with all of you. So thank you so much.
Welcome.
Thank you.
And with that, Melissa, if you could please call the roll.
Ms. Avila Farias. Ms. Gavildo. Present. Chair Cervantes.
Present.
Secretary Moss.
Present.
Ms. Lamont. Present. Treasurer Ma.
Here.
Mr. Prince. Here. Mr. Russell.
Present.
Mr. Fiegels for Secretary Sin.
Here.
Ms. Sotelo. Mr. Seeley for Mr. Velasquez. Here. Mr. White. Here. Mr. Williams.
Here.
Ms. Mirzarzad. Sorry. Here. Ms. Miller for Mr. Steppenshaw. Ms. Johnson Hall. Here. We do have a quorum.
Great. Thank you very much. We expect the meeting will run till about 11:30 noon. So if there are individuals who would need to leave early, just give us a heads up on that. I want to make sure we keep quorum, but we'll work expeditiously through the agenda. The second item on the agenda is the approval of minutes. I understand there may be some corrections to the minutes in the package.
Yes.
Melissa, would you like to clarify that?
It was brought to my
first?
attention that the Secretary Grant's votes were actually made by Sasha Kerrigan last month, so we'll make corrections to all of those aye votes in the packet from last month.
Right. And with that, I'd like to entertain a motion to approve the minutes as corrected.
So moved.
Great. Thank you, Director Russell. Is there a second? Thank you, Treasurer Ma. Our protocol is to approve the minutes with a motion and a second, so we will deem them approved. And with that, third item on the agenda, I don't have a lot of comments to make except for a couple of things, one of which is, again, to welcome the Secretary to the board and looking forward to her contribution to what we bring to the state in terms of housing and what she will bring to the bigger picture as well. I will say also that I'm working with staff on the workshop we've discussed before in March, which will be the content of our next meeting. We'll probably have another transaction or two to approve as well. So it should be pretty full and will likely go on much longer than today's session, I think. So with that, I'd like to turn this over to our Executive Director, Johnson Hall.
established outreach services, we've been able to reach somewhere in the neighborhood of 5.5 million folks through our earned media. And I would suggest to you that's not enough. We're going to need your help. We were asking just last week, what can the board members do in between meetings? Well, here you go. There is nothing. I've been in this business for a long time, and I can tell you, in spite of the wonderful efforts that we are making through our earned media, there's nothing like the word of mouth of a trusted partner. And each of you have an established relationship within your communities and can go a long way in sharing the good work that is about to happen for many, many folks who have been left out of the homeownership process. So I'm bringing it up to ask you to do what you do best, is to help us tell our story. So thank you in advance for the work that you will be doing on that front. Now, as we get deeper into the 2024 calendar, you probably know that we're now entering our most busy season. And so I wanted to give you an update on what the staff and I have been up to and what we intend to be doing on the immediate horizon. I'll start by sharing that our Chief Deputy Director, Chris Schultz, along with Member Russell, very recently, participated as panel members of the CSAC Leadership Forum earlier this month, where they discussed ways to address the state's affordability issues. And I heard that that went well. And so thank you, Member Russell, for your partnership, and for Chris for the work that you are doing within our communities that we serve. We're also grateful for all those chances to exchange information with folks working at the local level. That's something that we want to do more of. We don't believe our work is as informed if we're not touching the folks who are helping and assisting to bring the good news of affordable housing and to the folks who need it most. So thank you for your work there. So on that same day, Melissa Flores represented CalHFA at the Strategic Growth Council Catalyst Forum. Then last week, CalHFA's Director of Homeownership, Ellen Martin, and Deputy Director of Multifamily Programs, Shantae Spears, attended a decarbonizing low-income housing workshop hosted by SGC and BCSH last week. Also very successful, well-attended, and again, just a great effort in showing how not only what the state is doing, our platform, but how well we work together. So thank you, Sasha, for bringing that to us. And thank you for Lynn, wherever you are, and the great work that you're doing. We applaud you. Now, I will be engaging even more key partners in the coming year. So I've accepted an invitation to join the UCLA Ziman Center's Affordable Housing Financing Council. And I know many of you are familiar with that the group and the wonderful work that they do. Another piece of good news is that the California Homeowner Relief Corporation, which is our entity that runs the mortgage relief program, recently received a clean audit from external auditors for the 2022-23 federal fiscal year. And I want to thank Rebecca Franklin, who you will hear from a little later on, for her steadfast work in helping folks who've had challenges during COVID. We still have an opportunity to help them through the work that team is doing. So coming up on the immediate horizon, I will also be attending the California Tribal Nation Summit, as well as the 2024 HFA Roundtable Conference on Public Finance, which CalHFA helped to organize along with the host Morgan Stanley and ORIC. And simply what's happening there, several HFAs who are really active in the public finance universe, we're all coming together here in the wonderful state of California to talk about how we could do this work even better. So thank you to our partners, ORIC and Morgan Stanley, for hosting, and thank you for Erwin Tam, who behind the scenes was pulling it all together. So now, at the beginning of March, I'm headed to Washington, D.C. for the NCSHA Legislative Conference. I'll be attending that along with Marina Wyatt, who works for our treasurer, and is the new ED for the tax credit and SITLAC committees, respectively. We will be setting up some congressional meetings, and of course, the number one topic in terms of our advocacy on behalf of the state of California is the housing credit, bar none. So right now, we are working with our national partners to urge the Senate to enact the housing credit provisions, including in the Bipartisan Tax Relief for American Families and the Workers Act of 2024. If enacted, this legislation would restore the 2020 through 2025 the 12.5% housing credit allocation that expired in 2021, and lower the 50% test bond financing threshold to 30% for private activity bond allocations made in 24 and 25. And what that will do is result in more housing for the state of California. Finally, and nationally. Finally, I will be attending the annual Black Developers Forum, where our new secretary will be the feature speaker. And some of you might remember this great organization. Last year, we were honored as the 2023 Impact Honoree for the work that we do. And now we get to showcase the new secretary. So I'm excited about that. And I'm going to be there helping her to spread the good word of the state of California there as well. So we'll be sure to let you all know how that goes. So with that, Chair Cervantes, I hand the floor back to you.
Thank you very much, Tina. I'd like to move on to the next agenda item, item 4. This is the first of two loan approvals that we'll be discussing. The first relates to the Valley Pride Village project in Sylmar in Los Angeles. And we have Kate Ferguson, our Director of Multifamily Housing, to walk us through this and to answer any questions on this project. Kate, you have the floor.
Thank you. Good morning, Chair Cervantes and members of the board. For the record, my name is Kate Ferguson, and I am the Director of Multifamily Programs at CalHFA. Before I get started, I'd like to introduce the multifamily team that's here with me today. I have Shantae Spears, the Deputy Director of Multifamily, Steve Gallagher, the Chief and the head of our lending team, Kevin Brown and Jennifer Beardwood, who are our two loan officers. And these are really the people who have done all the work to get these deals put together over the past 6 to 8 months. So they're all here to support me and answer any questions you have. As a reminder, CalHFA had 12 projects in the MIP 2023 program. These projects received initial commitments from CalHFA in April 2023 at the staff level, and they received bond cap and tax credit allocations from CIDLAC and TCAC in August of 2023. Since that time, the projects have been underwritten, updated, approved by CalHFA's internal senior loan committee, and also approved by our executive director, Tina Johnson Hall. The board has previously delegated to the executive director the authority to approve permanent loan commitments up to $15 million. So all of the deals coming to the board exceed that $15 million threshold. The 2 projects being presented to you today, and one more to follow in March, represent the final permanent loan commitments for the 2023 MIP cycle. Today, CalHFA is submitting for your approval 2 board resolutions. Each resolution is specific to an individual affordable mixed income project development, which is recommended for permanent financing approval under both the CalHFA tax-exempt permanent loan program, inclusive of HUD risk sharing, and the CalHFA mixed income or MIP subsidy loan program. Next, oh, this is right. This is the right slide. Don't change. Okay, our first request today is for the approval of board resolution 24-6, which allows CalHFA to provide a $22,265,000 tax-exempt permanent loan and a $4 million MIP subsidy loan for the Valley Pride Village apartments. These apartments are a 180-unit senior rental project to be located in the Sylmar neighborhood in the San Fernando Valley, City of Los Angeles, Los Angeles County. The permanent loan is underwritten as a 40-year fully amortizing loan, and the MIP subsidy loan is coterminous with the perm. Valley Pride is a net new construction senior mixed income project, that's a lot, with a minimum age requirement of 55 years. Rents restricted to 30 to 80% of LA County area median income, which will result in actual rental rates which are at minimum 16% below market, up to 68% below. 88-unit market rate senior apartment project, which was originally built in 1971. The project is currently 98% leased, and as part of the scope of work, each unit will undergo moderate to substantial rehab. 92 new construction units will be developed on the site, which is currently the project's parking lot. The new units will be constructed 3 stories over podium and will provide sufficient parking to continue to meet the city's parking requirements. The construction lender will be RBC Capital Markets, and the equity investor will be Hunt Capital Partners. The proposed property management company will be FPI Management. CalHFA has experience with all 3 partners. The project's financing structure includes tax-exempt bonds, recycled bonds, 4% federal tax credit equity, state housing tax credit equity, and the agency's tax-exempt loan and mixed income programs. The project will be co-developed by Alliance Property Group, and we have a representative from Alliance here today, and Community Bible Community Development Corporation. I'm going to go ahead and run through the 3 exceptions to this that are noted in the staff report. The first is an exception that we see on almost every deal that we talked about extensively at our last board meeting, and that is the requirement of the tax credit investor that the deferred developer fee payment be prioritized over residual receipt lenders until the deferred developer fee is 100% paid. This will result in delayed repayment on the MIP loan for 9 years while that deferred developer fee is repaid. This is an exception to CalHFA underwriting standards, but it is recommended as it is current investor market standard. The second exception is the projected cash flow assumes operating expenses, which are $338 per unit, lower than those outlined in the appraisal. These expenses are recommended both by the developer and the property manager, and we consider the risks related to this exception to be minimal. The property management company has certificated that they think these expenses are reasonable and achievable. The third exception we have is the soft cost contingency is below CalHFA's minimum, which is usually 2% of eligible costs. That if you calculate the contingency based on all eligible costs, it is at 1.18%. The construction lender and the investor have indicated initial approval of this. They will be, our approval will be subject to their approval, given that this is really an issue during construction. Essentially what the borrower has asked is that we take out of the calculation the acquisition cost of the existing property so that we're looking at a true construction cost related soft cost contingency. So we are willing to recommend that based on the required approval of the construction lender and the investor. And finally, I just wanted to point out one sort of, we're calling it a weakness, but it's really a nuance to this property because there is an existing building and a new building. All of the units that are part of the 88 existing units are subject to the City of Los Angeles Rent Stabilization Ordinance, or RSO, which limits annual rent increases to an amount between 3% and 8%. Those are approved annually by the city. The developer has assumed a 5% increase on rents effective 2/1/24 for all units, which is consistent with the city's actual increase for 2024. As the units turn over, the RSO regulations will be replaced with TCAC rental restrictions. So the need to coordinate with the rental increases will become de minimis. And so we expect that to happen during the construction period for the new project. Additionally, a rent reduction is expected for 12 existing residents, which have RSO rents higher than the pro forma restricted LIHTC rents. And there are currently 15 units with rents projected below our pro forma restricted rents, and those will, on an average of $56 per unit. As we go through the rehab and the construction, we would expect that with all the unit turns, rents will transfer over to be LIHTC rents, and we will no longer be subject to measuring under the city's rent stabilization ordinance as well as the LIHTC requirements. So it's just during this period of rehab and new construction, it's a little bit more complicated. We have run our calculations and our cash flow based on the LIHTC rents, which we expect to be fully in place by the time the project is complete. I also want to remind the committee that this permanent loan commitment, this process is at the tail end of the development process prior to the construction start. We expect construction of this project to start very soon after receiving the CalHFA board approval. So the request for the board today is to approve a $22,265,000 tax-exempt permanent loan and a $4 million MIP subsidy loan. And with that, I'd be happy to answer any questions.
Great. Thank you very much. I'd like to see if there are any questions or comments from members of the board. I have Director Cabildo.
Thank you so much for the presentation. I'm curious about the RSO tenants. So you mentioned some tenants have rents that are below the pro forma rents, and you described it kind of there being a transition period with LIHTC, but wouldn't the tenants that are there and are paying below pro forma rents get to stay in their unit paying the lower pro forma rent until they decide to move out?
Yes,
Okay,
yes.
so it's not
So the transition is at unit turn.
and it's at their the tenant's choice to
Yes.
move out. It's
We
not
generally, when you, with a project like this where they're doing substantial rehab, you may see more tenant turn than you would on a normal in-place rehab. But we built that into contingencies of the pro forma. But yes, you're right. Those tenants, I think there are, what did I say, 15 with rents that are below the LIHTC maximum. Those can only be increased as the units turn over.
okay. Great, thank you.
Thank you, Director Cabildo. Any other questions? I have Director Russell and then Secretary Moss.
Great, thank you. First off, I just want to make a comment is San Diego Housing Commission did a study recently where they looked at all of their portfolio and looked at where they could do densification. And it just is a very promising avenue. And so it's really, great to see that we're not talking about, green fields. We're not talking about whole new development. We're actually looking at existing facilities and seeing where we can densify. It's interesting that the parking requirements, I noted that you are meeting the current parking requirements. San Diego, God bless it, the city has pretty much eliminated those parking requirements, and so we'll see if we can yield more on some of these properties. But I really appreciate the innovation in doing this kind of second wave of development. It's cost and land efficient. I did want to ask if the seismic review has been completed. There was note that there was a seismic review of the older structures to be completed toward the end of this month. Have we?
I have not read that yet. I'm going to turn to. Yes, we've received clear seismic on
Oh,
this.
very good, very good. Okay. Yeah, when you hear Silmar and seismic in the same.
Yes, yes, that's true. That's very true.
That's very.
Thank you for the question. That's a very good point.
I want to go to there's a note in here about green design considerations, and this is not so much about this project as so many of my questions are not. It is really about more generally, when we talk about green design considerations, we have PV, LED lighting, water heaters, efficient HVAC. The number one thing we can do with any structure to make it reduce greenhouse gas emissions is to locate it properly in an urban context. Because anything else we do means nothing if we build that building out in Cathedral City or the far reaches of the urban limits. I guess I just want to bring up this. It's nice that we have green design considerations here. I feel like the most important one isn't a part of the standard analysis we do, and I'd like maybe when we do our workshop to have a little bit of discussion of to what extent do we align our values and our requirements here with state policy around greenhouse gas reduction. So that's a comment, and I appreciate, of course, that they're doing mostly what, I mean, and I would say, looking at this is mostly required by Title 24 in any case. So we're not really, we used to be so far above in housing, we were so far above the standards. The standard has risen around us, so it's good that we're meeting that. And I guess I want to ask, with the residual receipts payment, you're saying that the market, investor market standard, so basically the money is calling the shots. And
Yes.
if we go out there and we say, no, we won't offer that prepayment, or we won't offer your priority position, investors might not be as interested in
Yes,
participating.
and we talked about this at the last board meeting, because I think of all the 5 deals we had last time, they all had the same exception. You'll see it in the next deal I'm going to present as well. The investor market nationally generally requires that any deferred developer fee be fully repaid in the 15-year, prior to year 15, when the tax credits expire. And that's because they want to make sure there's no hit to basis and no downward adjuster in their tax benefits. And so that is a very common standard in the market today. 5 years ago, it wasn't as common. We leave it in our underwriting guidelines because it's an important nuance to continue to point out and to continue to say, we are making this because it is a market standard. We're making this recommendation. But yes, you're absolutely right, that it's driven by that.
Okay. Well, I especially appreciate the second part of your response there, which is, why do we leave it in there if we're continuously sort of waiving it? I think that's right on point, is that we're continuing to call attention to market conditions and our role. So thank you for that. I have no further questions.
Can I add to that real quick? That very specific point, which is, I'm looking at Treasurer Ma. I think that this issue really needs to be looked at TCAC and CIDLAC, and for us, it seems to me that these exorbitant developer fees, I get why they're there, right? It's so that you can get basis, right? So if it's $10 million and a 4% deal, the basis, is going to be like 2.4 million, the equity coming into the project. My question would be, would we be able to increase our MIP loan by $2.4 million and start getting residual receipt payments earlier than 9 years so we can reinvest that back into housing? I'm not quite convinced that private nonprofit developers are taking that extra developer fee and putting it back into housing being built. And so I think that we need to look at our limited resources. This comes from the perspective of a housing authority that I see vouchers going into projects. It's our revenue from the vouchers, because we pay 110% of fair market rent, far exceeds the tax credit rent. They take those additional revenues and pay off their deferred developer fee loan. I'm a little confused. As a developer who likes to take advantage of those developer fees at my agency, I'm definitely confused about why we keep supporting very large developer fees. It seems to me we need to be investing back into our community a little bit more.
Fair question, Director Prince. I've got Secretary Moss.
It's all right, sir.
You're on the list.
Thank you. Just a clarifying question. Is there a relocation plan for the existing residents on the property?
No, that there is. But there's only one resident that has to be fully relocated. Not anymore, but well, Kevin, would you come up? Name.
Hello, board members. I'm Kevin Brown. I'm a housing finance officer in multifamily programs. I was the underwriter on this project. There is a relocation plan. We verified the budget with that. When the relocation plan was done, there was one resident that may need to have been permanently relocated, but that has since resolved itself. So that extra amount in the budget, it's kind of a cushion in case we run across that during the rehab period.
Great. I just wanted to lift that up because given that it's a 2-year construction period, we know that tenants can turn over during that period. 63 of these existing residents are voucher holders, so we want to make sure that we're encouraging sort of the relocation of those residents back to the property and mitigating any negative impacts for during the construction period. So thank you.
Yes, that is certainly the intent. Yes.
Thank you, Secretary Moss. Other questions? In fact, Treasurer Ma.
To Mr. Prince, we are having a conversation right now on the developer fee, and I think it's getting more and more difficult to finance a lot of these projects. And so the developer fee has not been increased, I think, over the last 7 years, nor have our fees at CIDLAC and TCAC. So, everybody needs to kind of keep up with, the cost of inflation and the amount of work that is being done. So would love to have your input on this issue. We are discussing it right now. Marina Wyant is our new director, and we purposely gave her a little time to transition so that she can really dig into this and work with the stakeholders in terms of what is the amount that it should be, right? Nobody can really work for free. We all know that. And it is getting more difficult to put these projects together, so.
Thank you. Council Victor.
Thank you, Chair. I'm Mark Victor. I'm acting secretary to the board today, substituting for Claire Chevet and Claire Targarden. And I just wanted to point out that the resolution for the Valley Pride Village project has an incorrect permanent loan amount in it that we'll have to correct. Kate very clearly, presented that the amount requested for the permanent financing was $22,265,000, and the resolution incorrectly has the amount that was initially approved but was subsequently increased. So we will correct that before we get it signed.
Thank you for that clarification. Are there any other questions, comments from, yes, I've got Director Limon.
My question was similar to the secretary's. I read somewhere that each unit was going to get paid about $1,000 for relocation fees. Is that enough? What does that cover? Does that cover also the moving fees of furniture and all of that?
So it is expected that most of the rehab can be done with the residents in place. There is the ability to temporarily relocate residents if needed for $1,000 a unit, if that need arises.
Okay. Thank you.
Thank you, Director Limon. Any other questions from members of the board? I don't see any. I think I've got maybe two, one of which is, by the way, Kate, thank you for walking me through this yesterday when we talked. It's very helpful. And I guess it's just not a question so much as this MIP discussion we had that extensively at our last meeting. It's been a flexible tool for us, and I kind of look at it where we're adjusting to sort of a market reality to get a project done and to provide affordable housing for people in the state. So I kind of view it as a good flexible tool that we've got to work with. I know that we're looking out for our interests in terms of getting it paid back, but we also want to get these projects done. So there's a trade-off there. It's more of an observation than a question. The second one, the relocation topic came up in a few questions. Secretary Moss raised this and others. I was struck by that out of 88 existing units, we only had one, at least in the package, who might need to be relocated for income reasons. I gather that's not the case at this point.
Correct.
Which I find is kind of extraordinary that we could actually keep people in place, acknowledging that they may also move for other reasons. But to get this done as an infill project on the parking lot and keep people in place while their units are being improved because they're 50-odd years old, to me, struck me as a really kind of a win-win here. So I feel, again, don't really have questions here, more comments, but I find this project really intriguing for a variety of factors, one of which is that we're doing infill, it's on a parking lot, we're keeping people in place and providing additional new housing on top. So I think that's all a hallmark of a good project. I want to see if there's any other questions from the board before I open it for any public comments. Don't see any hands raised. So I'd like to, Melissa, see if there's any public comments on this particular item before we move to a motion and a vote.
So I'm looking to the audience right now. Is there anyone here that would like to speak to the board, make a comment at this time? I see no hands raised. Thank you.
Thank you very much. So I'd like to ask for a motion to approve resolution number 24-06, acknowledging that the mortgage amount, which is stated at $19.645 million, actually should be, as I believe, $22.265 million, as per the agenda package.
Yes.
So that's the correction.
Yes.
And with that, is there a motion to approve Resolution 24-06?
So moved.
Director White, and I think it's a second from Director Russell. Jump ball. With that, Melissa, if you could please call the roll.
Ms. Cabildo,
Yes.
Chair Cervantes,
Yes.
Secretary Moss,
Yes.
Ms. Lamont,
Yes.
Treasurer Ma, Mr. Prince, Mr. Russell,
Aye.
Mr. Fiegels,
Yes.
Mr. Seeley,
Yes.
Mr. White, Mr. Williams.
Yes.
Resolution 24-06 is approved.
Great. Thank you very much. I'd like to again thank staff for the work on this project. We'll now move further north up the coast to talk about Agenda Item 5, which is the Battery Point Apartments in Crescent City. And Kate Ferguson, you have the floor.
Yes, thank you, Chair Cervantes, again. Our second request is for the approval of Board Resolution 24-07, which allows CalHFA to provide a $16,375,000 tax-exempt permanent loan and a $4 million MIP subsidy loan for the Battery Point Apartments. This will be a 162-unit project located in Crescent City, Del Norte County, California. The permanent loan is underwritten to a 30-year loan maturity with a 40-year amortization. The MIP subsidy loan is coterminous with the perm. Battery Point Apartments is a planned 162-unit new construction, mixed income development for families and seniors age 62 years and older. The project consists of 3 new modular construction buildings that will be made available for rent in Crescent City. Rents will be restricted between 30% and 70% of the county area median income, resulting in rental rates being from 29% to 80% below market. The construction lender will be RBC Capital Markets, and the equity investor will also be RBC, with RBC Community Investments coming in. The proposed property management company will be MBS Property Management. CalHFA has experience with all 3 partners. The project's financing structure includes financing from tax-exempt bonds, recycled bonds, 4% federal tax credit equity, state tax credit equity, and the agency's tax-exempt permanent loan program and mixed income program. The property will be co-developed by Step Forward Communities and Synergy Community Development Corporation. Both are California nonprofit affordable housing developers. Step Forward Communities will serve as developer and managing general partner, and they currently own 8 housing projects totaling 915 units, 1 of which is under construction, and 4 of those totaling 234 units are within the CalHFA portfolio. Synergy has focused on the revitalization of low-income neighborhoods and educating communities on the benefits of smart growth. As of 2023, Synergy had developed 6 housing projects totaling 375 units, financed with tax-exempt bonds and LIHTC in the states of California, Oregon, and Washington. There are 2 exceptions to the CalHFA underwriting standards that merit the board's consideration. The first, again, is the residual receipts split. The tax credit investor will require the deferred developer fee payment be prioritized over residual receipts lenders so that the deferred developer fee of $4.1 million is fully repaid by year 15, after which the surplus cash will be split 50-50 between the developer and residual receipts lenders. Additionally, there's a locality regulatory agreement in first lien position on this deal. The locality's density bonus regulatory agreement will be senior to CalHFA bond regulatory agreement and CalHFA MIP regulatory agreement, and will be subject to CalHFA review and approval in accordance with agency underwriting and legal standards. Allowance of this exception is recommended given that the locality regulatory agreement is not foreclosable and cannot remove or make ineffective any of the CalHFA liens or encumbrances. With that, I wanted to point out 2 identified weaknesses that I just wanted to highlight for the board. The first is that Step Forward Communities currently has a project within the CalHFA portfolio that contains 64 units and is located in Stockton, and this project is underperforming. As of our review of the 12/31/2022 property audited financial statements, we noted that the property operations had slipped well below a 1.0 debt coverage ratio. In working with the borrower, it's become apparent that this is largely because of delinquent tenants and major turnover caused by the same situation. Also, some one-time expenses related to flooding, tree removal, and exterior damage to the project over time had to be absorbed. The owners have continued to make infusions of cash over the past year to cover any delinquent accounts payables and to keep the loan current. We have had no payment delinquencies. The property is currently able to meet all its obligations. CalHFA Asset Management is monitoring this situation and will continue to work with the borrower until full restabilization of the property is achieved. We expect to receive an updated property audited financial statement as of 12/31/23 within the next 30 to 60 days, and we will, as we do every year, do a review of that and develop next steps based on our review. The second item that I wanted to point out is that the total estimated deferred developer's fee is not anticipated to be repaid from project cash flow by year 15. The developers confirmed that they will forego at any amounts outstanding in year 15, they will forego and donate to the property as a general partner contribution. This does not reduce the eligible basis or the tax credits available to the project. This condition will be documented in the Investor Limited Partnership Agreement as a condition to this loan. Again, these are permanent loan commitments that are coming at the tail end of the development process. We're very excited to move these deals into construction. And the request before the board today is to approve a $16,375,000 tax-exempt permanent loan and a $4 million MIP subsidy loan as presented. And I'd be happy to take any questions.
Thank you very much. Are there questions or comments from members of the board? I've got Director Williams.
My question is related to the modular construction.
Okay.
As we look at ways to speed up the time frame in which it takes to develop buildings once construction starts, and also looking at ways to maximize costs and energy efficiency, do we have a number of projects within our portfolio that have used modular construction, and do we see that there's any real significant benefits? There's the thinking that there should be, but do we have any evidence that modular construction really does save on cost, time, or the ability to do green building?
We do, and I will invite the developer to come up in just a second, because this is our first steel modular deal. We do have developers that routinely do modular construction. They do some of their, thank you, they do some of their own modular development and then ship the project to the site. So we've seen that fairly routinely. This is a new type of modular, and I'm going to let the developer give you a little background. I anticipated there might be some question. I think it's worth a brief discussion about why you chose this and what are the benefits, especially in the location where they're going to use this.
Thank you, Ms. Ferguson. My name is Bill Rice. I'm with Synergy Community Development Corp., the nonprofit developer sponsor. So it's an excellent question, and we're actually doing a hybrid. So we're producing 41 senior units, including the manager's unit, and then 2 family buildings that will not be built with modular, that will be family built. And actually, this provides us a real advantage. And one of the interesting things about Del Norte, of why we ended up going this route, is California has invested heavily in Humboldt County, just to the south. The state, or Humboldt has become a Cal Poly. There's a huge housing shortage there. The federal government sold wind rights So there is an explosion of an economic boom to the south, and labor is very in short supply. So one of the benefits of this hybrid model is we're able to deliver 41 senior units that actually will be built and we will have leased up by February of next year with the assistance of the Housing Authority, because they have a long waiting list for the 40 very low income voucher units. And so that will give us a really clear ability to instantly start leasing, which will give us time to get the family units then constructed, which will come afterwards. So we're able to deal with labor shortages and still deliver units on time and be able to serve a senior population immediately or reasonably immediately that we couldn't otherwise. Also, weather is a huge constraint up there. A lot of rain and wind. Beautiful area. I mean, we're 5 minutes from the Redwood, and this property is going to have ocean views from the community rooms up on top. I mean, this is going to be a phenomenal, no one has built workforce housing since the 1980s. So like we're scratching a ton of itches in a very important, beautiful area of our state. So the modular helps us be able to do that and also deliver tax credits, which helps with the financing of the overall transaction, which is why we went to do it. And what is unique about our modular is we're going with a steel provider. So these are steel-built modular units. We looked at a number of factories with the wood. I'm not disparaging wood. Everything has its different unique advantages. But for us, it's wood frame, or it's machine framed out of the steel to 1 millimeter precision. Because we're in a seismic zone, we're going to be able to weld all of that on site. The units will be sent for the senior 95% complete from the factory. So because of our weather concerns, because we want to get as much done during the summer months, this provides us an ability to really bring those units online so that we can meet all the needs. And the reason why we stuck it with just a senior, we find modular, because it's ultimately got to get on a truck, is efficient with 1s and 2s, and we found it less efficient from a cost perspective on 3 and 4 bedrooms for serving the family, which is why we stuck with a wood frame building. And just on top of it, we went with type 3 or better. So we're type 2 construction for fire safety on the steel, and we're type 3 for the wood framed buildings for the family. So we have off the charts, compared to most folks are doing type 5 construction. So we feel like this was a really good hybrid answer to solve a solution with a labor shortage in the area. So sorry for the long answer, but it's a great question, and I wanted you to know why we made the decisions we did.
Thank you.
Thank you.
Well, we have Mr. Rice, we have some follow-up. I had some questions on the modular housing too, but I think I'm going to defer to the treasurer.
Yeah, can you talk about insurance? I know
Yes.
a lot of the companies are not insuring because
Yes.
of the fire and the floods, and whether this is going to cut down on insurance rates.
Yes. Okay. So we were scared to death of insurance because we had worked on a prior NOAA transaction in town that was older, but only 45 units, and the insurance the insurance rates went crazy. So the insurance had gone from where we started when we acquired it. We ended up working for it. Those insurance rates moved to incredibly high. So the advantage of doing new construction, first of all, is way more competitive than anything that's prior than 1990s built. So we are finding on AC Rehab, we're having a very hard time in California finding insurance folks. Almost everyone has left the market. I will say on new construction, where we are at a higher fire rating, our insurance on 162 units is basically 60% of what it would be for 45 units with a substantial AC Rehab that's pre-91. So we do have competitive insurance bids for this, which we're very excited about, but it is largely the new construction plus the fire rating has been very beneficial for our insurance quotes. They came in way better than we expected, which we were shocked by because everything else has been really painful.
Secretary Moss?
Great, thank you, Chair. 2 questions for you. The first is, I love that the units are accessible. I wonder if you could talk a little bit about how that function and how we might be able to use that as a model for other projects. And then the second question is, I know that you're working with staff on the performance issues that were raised, but I'm wondering what your approach is to preventing evictions and stabilizing households. If you could talk a little bit about that.
Sure. So
moving
I want to
forward.
be clear, I'm with Synergy, not Step Forward,
Ah.
that has the interest in the other two transactions. However, because of my history of working with Step Forward, I am familiar at least with those transactions. And I've, talked with Dwayne Henry considerably about that. I know that they have a plan. That COVID was very rough on the Stockton property. And yeah, I'm sorry. So let me get back to the ADA. So we purposely designed the modular, all 41, to all be 100% accessible. And so we're doing that. We think this is, this is good because we've got senior low-income residents, and it's actually more efficient to do it this way. So there's a higher cost to do the ADA unit, but we have more efficiencies because of the steel production line facility, that it's efficient to do it this way. And then we're doing 15% on the family units. So this is one of the areas where we've been able to actually overperform on accessibility, because we'll have 100% on the seniors, twice the level we need, and we'll have 15% on the family units. So we're very happy about our accessibility, and it's a nice flat parcel. So we have wonderful features for that. We have community gardens for the seniors. We're even doing a community garden where, because of the rain, they can come together, have coffee, and grow. And then we've got a trail for the city to get through because we're right by two schools. And so going to transportation and carbon emissions, we actually think this is going to be phenomenal, because we're going to have 120 family units with 3 and 4 bedrooms where kids can literally go across the street to either the elementary school or the middle school. And then even though it's a rural area, they have a phenomenal bus system that has free transportation to all the schools for anyone, for including the teachers. They have wonderful loops that gets you to the Walmart, the Home Depot, the hospital, like everything in town. So it's a wonderful community, and we're excited about the accessibility and the pathways that we're going to have for the bus stops and everything else that's going to support that.
Are there any other questions for Mr. Rice, kind of on these different topics? Okay, Director Russell, I'll give you your sort of.
My sort of. So no, I just wanted to comment that the innovation that we're hearing about of thinking of ways that you can use not just a single delivery method, of looking at the populations and timing, and the localized perspective is all speak to the value of the nonprofit sector in housing, and that work costs money, and those developer fees that get invested back in this community are valuable. I did not want that to go unsaid in this setting. That it's really remarkable what you're doing, and you're working in a low, it's considered a low opportunity area. It's a poor county.
You have 69,000 AMI, and you're 5 blocks from the ocean. I mean, think about that.
Yeah.
I mean, we're truly going to serve, and we did the community meetings, and the younger generation is moving out because they can't find housing. They don't have a shot at buying a house in town. And so we've got the ability to take care of the seniors that are on fixed income. We're going to take care of 25% of the families at very low income, and then we're creating the opportunity for the 70% AMIs. So we were able to go into a city with a city that's doing really well on its housing element, but trying to look forward in the future and really has an economic plan for their community. Fabulous city to work with. And we're able to hit all the different needs from, can we plan around that? How can we maximize density? And the city was great to work with, and so was staff on, helping us figure out how we could make this a viable MIP proposal.
Well, thank you for your work in this community.
Other questions for Mr. Rice? Please, Director White.
fantastic for the state. So I just want to commend the developers, the staff in terms of the underwriting. You brought this week or this month typology innovation, and in my opinion, last month it was tremendous. Appreciate all the work.
I have maybe one, I had some questions on the steel modular units, and that you've answered the bulk of them. I guess my question is, so you think you can deliver the senior housing within a year? If I
Yes,
heard you
yeah,
right?
actually, we'll have modules as soon as we close. They'll begin with the steel order. They frame them, the assembly line, and we will start having them, I think, delivered in June through October. And so that will give us, what's nice, it will give us the time to do the infrastructure and to get the pads set for them. So this is really a good process of we can get the groundwork done, and then in this, the good quality months for construction, we can get these delivered. We can get them going. And then the other opportunity we have is we can now have a full leasing office. So even though the family's getting constructed, we can lease from there. And we can show, we'll have separate management offices and all that, where we have separate staff. It will operate as one property, but everyone will have their own things. But yes, the modular will help us speed up the ability to house and to ultimately complete the family
And out
units.
of curiosity, what's the time difference, do you think, between doing this approach in terms of delivering product versus doing it a more traditional way?
I think we'll probably, on the conservative end, be 6 to 7 months faster. But again, we would lose, so while modular is helpful, where we were originally trying to do, could we do the whole thing modular? We found we lost efficiencies. The larger the units we needed, or the 3 and 4 bedrooms, because you need to meet accessibility requirements. So that requires certain design choices. And then you need structural integrity as you start adding more bedrooms. Even though it's steel, you still have to engineer for that. So we found the efficiencies in the 1s and 2s and losing efficiencies moving to the 4, and our costs rose comparatively doing that. So I think it's a helpful tool. I don't think everything's about finding the right tools and the right solution. So we found it a very good solution for the senior portion.
Great, thank you very much. Any last questions for Mr. Or move on? Or? Please, okay. I think then I'll turn to Director Limon.
Thank you. I asked Director Tam to give me a list of previous projects that we've been involved in that are modular housing as well. So there are about 1, 2, 4. This would be the 5th. It would be really interesting to be able to track the cost savings and the time savings of all these projects as we think strategically about how to deliver for the state of California in a more sustainable, in a more cost-effective way. So getting an update, so that from what I see on those 4 previous units, 4 previous projects, the cost savings or the cost per unit is significantly lower than what we've seen. But I don't have anything here in terms of the time savings, so that would be really helpful for us, I think, to track. Thank you.
Thank you, Director Limon. Executive Director Johnson Hall.
Chair, thank you so much. And just for the benefit to all the other board members, we'll be sure to share that with you. And hopefully we'll be able to update regarding the time as well. But we'll share that information with you.
Right. Thank you very much. Are there any other questions on this project before we move on? I'm looking. I guess I had one, and unless there's any other questions of the board, this has to do with that step forward and their project in Stockton, which is having some significant issues. My understanding is that with respect to what we would expect of a developer property owner, they have stepped up in terms of their responsibilities in making payments and so on. I just want to clarify that from our perspective as a lender, we've got faith in them as a counterparty that they can deliver as
Yes,
Any-
I would say very definitely. Our asset management team is monitoring it. We will have additional, we routinely review every deal when we get their financials in once a year, which was when we identified this. We've been talking to them as recently as this week about what the next steps are. It's really stabilizing the tenants and then doing the, fixing the units that were destroyed and evicting tenants that were misbehaving. So I think now they've stabilized their tenants. They just need time to stabilize the property cash flow.
Thank you. Are there any last questions from the board? Don't see any hands raised. Melissa, I'd like to see if there's any questions or comments from the public.
Again, I'm, excuse me, looking at the audience. If anybody has any questions or would like to make a comment to the board, would you please raise your hand, let us know? No hands are raised. Also, while I have the mic open, I just want to remind board members to please use your microphone when you're making comments. Thank you.
Duly noted. Thank you. I'd like to ask if, first of all, let me check with Mark Victor. Are there any adjustments to this motion, or are we good as stands? No, we're good. Yeah, the dollar amounts looked right. Okay. I'd like to see if there's a motion to approve resolution number 24-07. John Paul.
I make the motion.
Thank you, Secretary Moss. Is there a second?
Second.
Thank you, Director Williams. We have motion made and second. Melissa, can you please call the roll?
Ms. Cabildo?
Yes.
Chair Cervantes?
Yes.
Secretary Moss?
Yes.
One moment. I'm almost there. It was Secretary Moss. So one moment. I'll be right to you, Ted. Ms. Lamone?
Yes.
Mr. Ballmer for Treasurer Ma? Yes. Thank you. Mr. Prince? Yes. Mr. Russell?
Aye.
Mr. Fiegels?
Yes.
Mr. Seeley? Yes. Mr. White?
Yes.
Mr. Williams?
Yes.
Resolution 24-07 is approved.
Thank you very much. And once again, Kate, I'd like to thank you and your staff for all the work on these projects and for walking us through this. Thank you. With that, we'll move to agenda item 6, update on the strategic plan and budget. We have Erwin Tammer, Director of Financing, and Rebecca Franklin, Director of Enterprise Risk Management and Compliance.
Good morning, Chair and Board. Rebecca Franklin, Director of Enterprise Risk Management and Compliance for CalHFA. Also a girl who grew up in Crescent City, so just thought that's a funny story. I think that building might be the tallest building that they've had in the city for a while. So we are here to discuss our performance from the strategic perspective as we approved, the board approved the strategic plan and business plan last May. We committed to coming in, updating everyone on the status and performance of the agency from the strategic plan level quarterly. And so we've completed 2 quarters now. So all of the data you're receiving today is as of December 31st. I just want to remind the board that when we approved the strategic plan and the business plan last May, what we did was separate kind of our long-term goals and objectives into a 3-year plan. So that's when you see goals, and they are, whether we meet that goal is measured through the strategic measure and objective. That is the strategic plan. So that runs through 2026, as well as the business plan, which we will update annually. So the board sets the tone, the tenor, and the vision for the agency through the strategic goals and objectives. And then Ms. Johnson Hall leads her team in developing initiatives to kind of get us there, kind of a path forward. So what you're looking at on the screen right now and in your packet is the goal 1 for our strategic plan. As I've mentioned before, we're going to be doing exception reporting for these goals. So if they're green, they're good. We're going to kind of just move on. If they're yellow or red, we will file exception reports with the board and go into more root cause detailed analysis. So I do want to highlight again, as we do the latter part with Mr. Tam, is that the strategic goal for lending impact is growing and progressing CalHFA products versus the goals we talk about in our business plan and production is the total impact we make to the state of California. So we get the honor of sometimes distributing one-time funds on behalf of the state of California, accessory dwelling unit programs, the Dream for All program. So that's measuring our total impact, but that's not growing the CalHFA product itself, which is a strategic goal, right? My Home, Zip, those are our core products. And we want to make sure that we're sustaining the agency both with, you know, the ability to distribute and make impact to the housing continuum through one-time funds, but also making sure our products are growing and doing a performance so we can sustain this agency in perpetuity. So I just wanted to make sure that as we get into a second set of the business plan production numbers, that's really the total impact. So green for, actually the entire dashboard luckily is green, so my job is really easy. Goal 2 is also green if we want to go there. And then the third goal, which I want to highlight, is we've actually already met one of our measures for our strategic plan, which was receiving recognition of awards. We've exceeded that goal by receiving 2 NCSHA awards in the past quarter. So we've actually exceeded that goal. So I love check marks and checking things off. I don't think that's a surprise to anyone on the board. So love that. And the last goal, again, is we're in a green. So we will come back at the end in the April-May timeframe to update on the third quarter performance. Lastly, on our business plan, so we do talk about our strategic objectives. We're green. I want to highlight that last quarter we did have one that was yellow, and that we received the information and guidance we needed from one of our governmental counterparts to move that item from yellow into green. So actually at this point we are trending positive on achieving all of our strategic objectives. Lastly, this morning, I do want to highlight our accomplishments for the last quarter. So that was as of December 31st. As I said before, we did receive 2 Program Excellence Awards from the National Council of State Housing Agencies at our annual conference. There's a really great picture of our single-family staff as they announced the award. And the total glee and accomplishment on their face is something that I love to look at when I'm trying to figure out how to make all my programs as successful as theirs. Additionally, my favorite executive director, Ms. Johnson Hall, was elected to the NCSHA Board of Directors. At the national level, she'll be able to help guide policy, be in the conversations with all of the different HFA agencies in the nation. And we're really excited to have her presence on that council and all the work that she does. It's, 2 jobs in one now. So Ms. Johnson Hall, I'm really excited for you to be on that Board of Directors. And lastly, as of December 31st, we have helped 722 homeowners add accessory dwelling units to their primary residence through our ADU grant program. So, housing, trying to put units out there into the marketplace, and our ADU program is a very, very successful one, and we're really excited to be able to help those over 700 homeowners. So at this point, that ends my part of the presentation. I'm going to turn it over to Mr. Tam for the business plan and budget updates.
Good morning. Good morning, everyone. I just have 2.5 slides to go over with you. On page 8, again, this is as of December 31st, 2023. So this does not, so you may see on the right side of the page, is our multifamily production, the number of units being low, but that, again, does not include any of the units that this board has approved since December. So in the January and February meeting, obviously the board has acted to approve certain MIP projects, and those units have not been counted yet. On the single-family production side, we are above projections for, especially including our flagship My Home program, and that will be reflected on the last page, which I will go through, which is a page of very small numbers again. There's a chart on page 9, which just summarizes operating expenditures, but that just is picked up on the final page, which again is our second quarter budget update. So the board was presented a 5-month actuals last month, and this is again just 1 month roll forward. We have not changed. There's no major changes to the end of fiscal year projections. Our single family programs to continue to outperform expectations. And I just wanted to say that in upcoming meetings, I will be presenting at the March meeting 5 financing resolutions for consideration by this board of directors. These financing resolutions do authorize the executive director and her designees to conduct the business of the agency for the following fiscal year. And in May, we will do a third quarter update on the strategic plan, the business plan, and the operating budget, and also ask the board to consider adoption of the business plan and operating budget for the following fiscal year. So that will be coming up in the May meeting. With that, I will turn it over to the chair and the board for questions.
Great. Thank you both very much. Are there questions,
Question?
comments? I've got Director Williams.
First of all, great work, and thank you all. My question is from Strategic Measure Goal 4, which is on page number 5. Increase Great Place to Work certification score 5% by 2026. Could you elaborate a little bit on what's the process or the agency or the entity that sets designations, and how does that come to play with our staff and our workplace?
So the Great Place to Work survey is a survey that we conduct annually. It's all staff. And so it measures us in, I think, over 20 different kind of categories or zones around different elements that would make a positive, supportive, and engaged working environment. So that is a specific question in the survey that we are measuring. And so we want to make sure that we are assessing our ability to, have happy, fulfilled staff. Our staff is the backbone of the entire agency. They're the ones that make everything work. And so we want to make sure that it's an assessment of kind of the leadership and our, how we can make adjustments. Also, periodically through the year, through the calendar or the fiscal year, we do what we call pulse surveys, in which some of those, so we do the annual survey in May, and then we kind of look at where we could improve, where there's things that maybe we want to work on. And obviously the survey can be, kind of looked at through different demographics, tenure, gender, position, et cetera. And so what the team does is look at a pulse survey. They look at a small subset of that, kind of those different categories, in order to assess how we're doing in that area. Would you want to work here? Do you feel, connected to the strategic plan, the mission, the vision? What you would consider, it's not necessarily a traditional engagement survey, if there's any survey buffs in the room, but it is what we would consider, assessing kind of that different workplace environment elements.
All right.
Yes, Executive Director Johnson Hall.
Yeah, I was just going to add to that, and I do want to acknowledge the great work that has been put in here, and it's very purposeful. I sincerely believe that retention and engagement of your staff is critical to the success of the organization. And so we are very, very deliberate in this regard, not only because that's just what I believe, but I know that to be true. But I'm also very conscious of the fact that we are a very lean organization. And so when and if we lose folks, we're going to have to. And I'm so sorry. And they've warned me twice to turn that thing on. But I am very conscious of the fact that when we lose big. And so, and I'm also trying to create a ladder of engagement for the next step, because I also feel that not only retaining and engaging people is important, but also creating a path for growth is important. So through this survey, we not only get the retention, we not only get the engagement, but we also get to gauge what the next up looks like and what we need to do to potentially reposition our efforts to create a ladder for the next for growth and for establishing a bench strength, which I believe is critically important.
Very good. Thank you.
Thank you, Director Williams. Any other questions, comments from the board? Don't see any. I've got a question, I guess. I'm going to go to the page with the small numbers. In that, so it appeared like in terms of multifamily lending, we're kind of tracking what the projection was. We think we'll end up ahead by the end of the fiscal year. Single family kind of surprises me, honestly, in the environment that we're in, where rates are, and the challenging housing market in California. I'm frankly surprised that we're doing as well as we're doing. So maybe just walk me
Right,
through that.
and I think I touched upon this at the last board meeting, and I think the rationale remains the same, is that CalHFA is one of the only providers, or let me take this back. CalHFA is the nation's largest provider of down payment assistance to low and moderate income individuals, and so therefore, it's in a high interest rate environment, in a high home price environment, we will see Californians flock to the agency to provide that for them, just extra bit of assistance that they need.
And to refresh my memory on this, the income threshold for individuals getting this help from us, where are we on that? What's the range?
So I believe it's up to 150 AMI for our single family programs.
Okay. All right.
And Chair Cervantes, I
Johnson
just
Hall.
want to, thank you. I just want to add one other important element about our programs is that somewhere in the neighborhood of 60% of all of the folks that we touch are representative of communities of color. And so having worked in the banking industry in this universe, I can tell you that is something we need to brag about often. And I'm seeing Director Limon, who's also very familiar with pathways to home ownership and what that looks like for the state of California. So I want to take a moment to say how important that is, especially in light of some of our historical pathways in California, which have been some folks have been locked out of that conversation. I'll just say that. So this is very important for us to acknowledge the work here.
Thank you very much. I don't have any other questions. So look again, any other? Oh, Secretary Moss.
Thank you. Just a quick question about, I think, Rebecca, you said, luckily we're all in green. I don't think it's luck at all. It sounds like you all are doing fantastic work. So just wondering how you socialize this incredible work around both the updates on the strategic plan. I assume it's on the website. And I think to Executive Director Johnson Hall's last comment, it could be interesting to have sort of narrative about these sort of impacts that are quite significant to how the work of CalHFA is actually affecting Californians. That is paired with the numbers and the charts, because I think the storytelling, as was mentioned earlier, is really important. So just curious, I think, Mr. Tam, you just referenced a data point about being the biggest down payment assistance. I know that. So I'm curious if others know that and how we're promoting that.
Thank you, Secretary Moss. I think that if you look at goal 3 from the strategic goals, it really is us trying to tell our story a little bit better. And I do think that Ms. Johnson Hall has really, this was, not to put you on the spot, if this was a pet goal, I think this is hers, in that I think we do a great job. Our teams are phenomenal. We do great work. Mr. Russell very kindly sits on the CalHRC board, which I happen to also participate on. And he also talks about telling about the great things we've done, not only from a production standpoint, but from how we're doing and achieving these great production goals in our community outreach and our how we've gone in and used the different strategies around community-based organizations, et cetera. And so I think that we are working on that. I think we do need to do a better job in that. From this strategic goal, this is our first year with the strategic plan and business plan. I think that the board will be pleased to see the accomplishments report that we'll complete at the end of the fiscal year that will kind of highlight some of these data points and tease it out a little bit better. But it is something that Ms. Johnson Hall has put on her executive team to strategize on we do great work, we just need to talk about it. We're just sometimes our heads down, and I really like check marks and I'm just checking things off. So it's point well taken, and I think it's something that the team's working on, and hopefully you'll be seeing the results of that storytelling, telling our story a little bit more in the end of the fiscal year.
Executive Director Johnson Hall.
Thank you again, Director Moss, and thank you for the guidance on that and your suggestion. This is thank you, and thank you, Rebecca, for acknowledging that this is where we need to put in the work. All right. And we are not only hiring more folks to do this, we have our actually Director of Communications and Marketing behind us, but we're also putting money behind this as well. That is something that had not been done in a major way before I came here, frankly. So we're changing our whole thought process about how that works. We've also received in the past some level guidance around how we might do this from your staff, that we are incorporating their great ideas about how we might do this more. Credit to, she's sitting back there quiet, our housing secretary, Deputy Secretary Sasha Kurgan, who we have the benefit of hearing from her on how that has worked in other places where she's worked. And we're actually hiring outside folks also as needed to get us into those spaces and places, being cognizant of language and things like that will help us to reach more folks that we have not unfortunately been able to reach in ways that make sense for those populations. And so we will be providing a report in the future which talks about how those efforts look, how we're gauging it, as a report back to the board a little later and after DFA has been launched, because that is of critical importance right now. But we have a goal of sharing what those efforts look like by the end of the year.
Thank you. And I think I've got Director Russell here.
Yeah, since I've been called out by Ms. Franklin here, I feel the need to respond. First of all, I want to go back to a phrase she said early in the presentation, is that we have the honor of receiving one-time funds. And unpacking that statement is there's a lot of work involved in standing up a whole new program for one cycle, whatever that cycle is. And that's remarkably challenging, and I think the staff has risen to that occasion. I just want to cite, first of all, the feedback between our Dreams for All and our HRC, the homeowner relief, the dynamics of who we're reaching and what the conduits are, what are the community-based organizations, informed each other in terms of like improving our game overall. And so I want to give you props for that. I also want to say that as a board member of HRC, I had the honor of being interviewed by the auditor, and they spent a lot of time complimenting me on this agency I was aboard. Well, complimenting staff, really. So I just want to say that is a rare experience for me. I mean, auditors like to find things wrong. Most of the conversation was really quite complimentary of you, your staff, the organization, and generally talking about CalHFA. So when we talk about, those don't probably appear, I don't know if those comments appear, like how do we build our cultural competency? Mm-hmm. Does that really appear in here as part of our strategic plan? We're doing it well. Maybe that's a refined portion of this, but anyway, again, having been called out, I had to respond.
Thank you very much, Director Russell. Any other comments or questions from the board? Don't see anything. I'd like, Melissa, if you could see if there's any public comments or input on this topic.
Anyone in the audience interested in making a comment at this time? No hands are raised. Thank you.
Thank you very much. Thank you both very much for the update. We appreciate it. Thank you. Agenda item 7, we've got a couple of informational reports in the package, which I'm sure we've all reviewed. I'd like to see if there's any questions on those that individuals have. Don't see any hands raised on that, so those will just stand. I don't know if I need to maybe just ask the question, if there's any questions from the public on that, just ask the question.
Anyone interested in making a comment at this time? No hands are raised.
Thank you very much. And then agenda item 8, other board members, we don't have anything agendized here, but if there's topics that individuals have that we'd like to sort of pick up maybe at a subsequent session, that might be helpful to note that. Of course, you can also reach out to Executive Director Johnson Hall. I did note from earlier discussion points, there's some discussion about the bigger picture in greenhouse gas reduction, infill versus greenfields, and so on. That might be, I think, something to flesh out. The developer fees discussion came up. Big topic, but that may be something we might want to touch on later. Modular housing, sort of newer technologies with respect to housing development, and tracking that, I think, is really intriguing, and so have to see where we might fit that in. And then we talked about improving our outreach. So maybe there's a follow-up conversation I'll have with our executive director on that. So those are the items that I had jotted down here. If there's anything I missed that people would want us to talk through? I don't see anything. I know you're not shy, so you'll all let us know. And maybe with that then, any just general, this is agenda item 9, general public comment on items that are not in the agenda. Melissa, if you could just see if there's anyone from the public who has something to add to this at the end of our meeting.
So we're in the public comment period. If there's anyone in the audience that would like to make a comment or ask a question, no hands are raised.
Thank you very much, which means I believe we are now at the last item, which is adjournment. I had an over-under at this meeting at 11:30, and I think we pretty much nailed it. And I'd like to note that we're sort of banking time here. So if a subsequent meeting goes long, just realize that we ended at 11:30 here. So with that, meeting adjourned.